The U.S. Treasury market is deep, it's wide, it's liquid. It is the safe haven to end all safe havens. Yet there's a lack of liquidity, and that is being blamed for the sell-off today. Is that reasonable to you?
Yeah, I think there is a lack of liquidity. I think it's largely due to positioning. I think people got themselves very comfortable that the growth here had slowed down and wasn't growing, that there were problems in Europe, that Europe wasn't going to get its act together. And all of a sudden, I think you got this trifecta that's really hitting. You've got fundamentals all of a sudden look better. ADP was decent. You've got the technicals where the positioning's wrong. Everyone was talking about how low bond yields are. That's no longer true. And finally, you have this catalyst, which I think is a deal for Greece.
But, you know, when you take a look at the bond market, that's where people go for safety, right? Unless you're in high yield. I mean, is this going to fundamentally change the way investors view this asset class?
Well, people have been waiting for this for a long time, right? That the bond market's going to see the end of its 30-year incredible rally. The bull market's over. It's going to be the lack of a safe haven, not a safe haven. That is to be determined at this point, whether we've really seen the start of that move. But what you are seeing is more volatility in bonds than even stocks. And to Peter's point, what you're seeing is people have just plummeted into the same assets for years. And now, even now, they don't really want to wholesale sell because they don't know, is this the real thing or not? So what you're seeing is trading at the margins that are shifting around the values in this market by hundreds of billions of dollars each day and causing a big tantrum. But people aren't locking in necessarily those losses by actually selling their holdings in mass.
Peter, I like what you tweeted earlier today, which is markets always revert to the mean. The question is, which mean do we revert to? Are we seeing that right now?
Yeah, I think that's one of the things we've been seeing. We've been seeing buying of the dips in the Treasury market because everyone's looking, well, it's much cheaper than it was a month ago when we were 188. And I think the realistic issue is that we were at 260 on the 10-year last summer. We've added over 3 million jobs since then. So why isn't 260 a more realistic level? So I think people are focused a little bit too much on the near-term relative value, and I think we've got to go back a bit longer term, and that's why this sell-off has more room to go.
Well, we were talking before we came on camera about how really what's at play here is inflation. The models for inflation have really broken down. We don't have a sense. I mean, the money printing of central banks hasn't ignited inflation yet. People are questioning what will. And all of a sudden, you're seeing inflation starting to tick up, and people are wondering, is this going to be it? Is inflation really going to surge? What's the trajectory of this? And the sell-off is really in the 30-year bonds, the 10-year bonds, not the 2-year bonds. This is not a Federal Reserve.
What does that mean?
This is not a Federal Reserve spurred sell-off. This is an inflation. This is all about inflation.
And we've also seen Yellen on that subject moving the goalposts a little bit. Bernanke had everyone focused on PCE. PCE has not been showing signs of inflation, but she has gone out of her way to say we have to look at alternative measures, and there are alternative measures that are showing higher inflation.
I don't want to turn this into a Greek discussion, but speaking of moving goalposts, what is the link to Greece, if any? Will a last-minute resolution in Greece on Friday, on Sunday night, as so many do expect, halt the selling?
No, I think that will actually make the selling go faster here. I think what you'll see is a risk-on trade. So we're already seeing it in Europe where bunds and French oats were selling off, but Spanish and Italian bonds were rallying. So I think the whole flight to safety bid that's been out there will disappear. So bunds and treasuries will continue to sell off. And I do expect a deal, given what we're hearing, what we're seeing. And what really is Draghi, I think, wants a deal. Merkel now wants a deal. So a deal will happen.
I just have to say, I was looking at my world bond screen on the Bloomberg terminal, and it was, every bond was like in the red, in the red, in the red, in the red, and there was one green spot, and it was Greece. And it was sort of this irony, of the whole thing. This has always been the red spot, and now it's green. We're up. Bonds are gaining, so.
Reverting to the mean.
Exactly.
When you take a look at across the bond market with corporate, high yield, sovereigns, is there a market that has adjusted to this volatility that we've seen?
Good question.
Not really. So far, I think the credit markets, so investment grade and high yield, have held in very well. So if you look at some of the ETFs, whether it's HYG or JNK, they're down a little bit today, but they've definitely outperforming the Treasury market. So far, I think people have been very reluctant to sell their corporate bonds.
Is that a risk-on trade? Is that part of the
It's partly because it's risk-on, so you're seeing equities up, so that's one reason to hold on to them. And then, two, I think people are extremely worried about the liquidity. So if they sell their corporate bonds in a moment of fear, they might not be able to buy them back. So I think we need another leg down, and we need to see equities lead the way before we see credit spreads widen.
And to that point, I mean, the volatility that we're seeing, is it really that traumatic yet? Or is it really just the concern of how bad it will get, right? I mean, if it just keeps going and going and going, and you don't feel like there's a bottom like you did at some points in late May of 2013, that could become a problem. But this, the blips and moves are not kind of.
And a lot of investors also feel comfortable that they own a 30-year corporate bond with a 4.25% coupon, and that's value. They don't feel as comfortable owning a 2% 10-year.
But they'll own Petrobras 100-year bond for 8.25 coupon.
See the coupon they like.
I have to ask you to break down liquidity for us a lot, because we use that word constantly, and we have a lot of global liquidity thanks to the European Central Bank, thanks to the Federal Reserve, the Bank of Japan, chasing yield across asset markets, but we have relatively limited trading liquidity.
Yeah, and that's one of the things I look at, and one of the things that's concerned me over the past couple weeks is in the Treasury market, you will see a lot of trading at a specific price. So a lot of back and forth in a very narrow price range. But as soon as someone comes in with a larger move, it instantly gaps wider, which tells me that it's really people kind of scalping, whether it's algos in there, all sorts of, I'll call it faux liquidity. Because it looks like there's lots of liquidity, but it's only for that very narrow price range. The second you start gapping, everyone's out, and it resets and comes back in at that new higher or lower price.
Doesn't this whole game change once we see the Federal Reserve stop reinvesting their maturing securities and they actually start to tighten?
Well, we've already seen it hit in the off-the-run treasuries. So all the treasuries that the Federal Reserve have been buying, all these high-coupon, longer-dated treasuries, so the off-the-run 20 to 30-year bonds, have become very illiquid. They are hard to get good pricing on. They're not accurately priced. We're even seeing some discrepancies where TLT, which is an ETF that references them as trading. And so that's very different, and I think that's a big function. The Fed was the big buyer of this, so no one knows where the value is on these bonds, so they've lost that liquidity, which, again, points to this whole lack of, true in-depth liquidity and value seeking.
Price discovery, once again.